Hello, this is Rochelle Agatha, and this lecture will be on analyzing transactions. So let's get started. Okay, after studying this chapter, you should be able to do a number of things. The first of which is to describe the characteristics of an account and record transactions using a chart of accounts and a journal. So we're going to talk about where we actually put transactions and what happens to them after we make a transaction. You're going to be able to describe and illustrate the posting of journal entries to accounts, prepare an unadjusted trial balance and explain how it can be used to discover errors, discover and correct errors in recording of transactions. Okay, so our first objective is to describe the characteristics of an account and record transactions using a chart of accounts and journal. Okay, accounting systems are designed to show the increases and decreases in each financial statement line item as a separate record, and this record is called an account. So you think of your account as the holding place of everything that goes in and out of it so that you can come up with a balance at the end. So here are our basic T accounts, and this is something, remember I mentioned earlier, if you were doing note cards, this is definitely something that would be on your note card. These are your basic T accounts, and as you can see, here's our accounting equation, and hopefully you remember the accounting equation of assets equal liabilities plus owner's equity. And your basic T account is set up the same way no matter what type of account it is. But we're going to spend a few minutes talking about what the difference is between the type of accounts. So on an asset is a debit account. DR stands for debit. So notice on each of the T accounts, see here's the liability and the equity, the debit and the credit go in the same spot, but how they act in the type of account is different. So for an asset, the debit is on the left and the credit is on the right. For a liability, debit on the left, credit on the right, and for equity, debit on the left, credit on the right. So that's the same for everything. However, an asset is a debit account. So a debit is a plus and a credit is a minus. Then remember, since both sides of the accounting equation have to be the same, on the left side is your debit accounts and over here are your credit accounts. So a liability is a credit account, so the credits are pluses. And an equity is a credit account, so the credit is a plus. So a credit will make the account bigger in equity and bigger in liability. And on an asset, a debit will make the account bigger. And I know this is a lot to take in to start with, but the T accounts are really the way that we do accounting so that we can get it all down. So some of the terms that we talk about throughout this course are debit and credit, which I've just mentioned, and then a normal balance of an account. So the normal balance of an asset account is the debit, hence the DR at the top. The normal balance of a liability account is a credit, and the normal balance of an equity account is a credit. Now notice equity, if you recall, equity is increased by net income and decreased by drawing. And net income is made up of revenue less expense. So my revenue T account is a normal credit balance where a debit is a minus and a credit is a plus. My expense is a normal debit account, so it looks like an asset where the debit is a plus and the credit is a minus. And my drawing is a debit account like an expense, and it is a plus on the debit and a minus on the credit. And the drawing is where partners take money out of a business. So this is our basic set of T accounts, and I'm going to go ahead and move on, and we're going to talk about some more details. Let's do a couple of different transactions. Let's say a company started out with cash and they made an investment. So here's a $500 debit to cash and the partner gets a credit to his capital account. So this is your typical first way to start up your sole proprietorship. The owner puts $500 into the business. So here's the little A. He debits cash, he credits equity. And notice that you put it on the right side of the T account depending on what you're doing. So cash, being a debit account, has a debit of cash, which is a plus, and Smith Capital is an equity account, and it has a credit, and a credit is a plus. So both sides of my accounting equation are in balance at this point. Then let's say that you buy some supplies. So up here, you're going to buy the supplies, and you're going to buy it on account. Accounts payable is a liability account. So notice here's my little B. So I credit my accounts payable, and I debit my supplies for the $300. So that'd be like you go down to the store and you say, I'm going to buy $300 of supplies on account, and that's called an account payable, and that's a liability. Then when you pay the accounts payable, because it's time to pay your invoice when you get it, you're going to debit the accounts payable, and you're going to credit your cash. So I notice I have a little mistake here. That should be 200. So please note that right here, the 500, this is how you balance the T account. The 500 less the 300 should be 200. So note that. My supplies I carry down, and they're 300. My AP is 0 because it wipes itself out. Debits minus credits is 0. And my capital is 500 because I bring it down. So that's kind of a basic set of transactions. You're going to do some of these in your homeworks. Okay, so after you make your transactions in your accounts, then you need to understand what a ledger is. And a ledger is a group of accounts for any entity. And a chart of accounts is a list of the accounts that you use in your ledger. So you think about all of the accounts that you could have, and that would be your chart of accounts that you're using in that ledger. Okay, so assets are the resources owned by the business. So we think of assets as things that we own. Cash, supplies, prepaid expenses, buildings. Liabilities are debts owed to outsiders or creditors, such as accounts payable, notes payable, wages payable. They don't always have the word payable in it, but that's a good clue that that's a liability. Owner's equity is the owner's rights to the assets of the business. So a drawing account represents the amount of withdrawals by the owner. So the equity is what's left over after you have your assets less your liabilities. Revenues are the increases in owner's equity as a result of selling your services or your products. They make equity go up. Remember, the T account revenue has a normal credit balance. Things that are considered revenue early on in our accounting career here are fees earned, commission revenue, rent revenue, service revenue. The using up of assets or consuming services in the process of generating revenue is your expense. So think about like a type of business. You're a house cleaning business, and you sell your cleaning services. And in the course of cleaning people's houses, you're going to use cleaning supplies. So as you use those supplies to earn your revenue, you're consuming a supply in the course of earning your revenue. Or another example would be you're a consultant and you provide consulting services, and you have to purchase office supplies and pay for gas and travel to go to your clients. So those are the expenses that you incur while you're earning your revenue. Some other types of expenses are wages, rent, miscellaneous. Remember, every transaction affects at least 2 accounts. So I'll say this numerous times throughout the semester. For every debit, there's at least 1 credit. Everything stays in balance. There's always at least 2 things happening in a transaction, or it wouldn't balance. A transaction is initially entered in a record called a journal, and the process of recording a transaction in the journal is called journalizing. So journalizing requires some steps. You're going to record the date, the title of the account, enter the amount in the debit or the credit column. So you're going to enter your debit and your credit. You're going to put in a description. Usually you put your debits before your credits, but as long as you balance, that's always good to remember. So here, remember those T accounts we did a little bit earlier? This is kind of an example of what it looks like in the journal. So let's say that an owner makes an initial investment of cash. So this is the journal entry in the journal. And note that I have my date of September 1st, debit cash $8,000, credit S Morgan Capital $8,000, and I put my description. This is if you're doing accounting by hand, and we teach it by hand to start with. Then on the 15th, I bought supplies for cash for $200. So I debit supplies for $200 and I credit cash for $200. And then I received cash from my customers for services rendered. So I got cash of $500 and fees earned, which is my revenue of $500. So this is a typical journal. It's called journal. It has a page number. It has a date, a description, post reference we'll talk about later, but that's basically when you post this to the ledger, you put a notation here, and then you have a debit and a credit. So here's the effect in the T accounts. So here's my cash, debit, my Morgan Capital, credit. So if you go back, here's what it looks like in a journal. Here's what it looks like in a T account. Once again, here's my balance sheet T accounts. Okay, my debits, my assets a debit, my liabilities a credit, my equity is a credit. Here's my income statement T accounts. Here's my expense and my revenue. Expense is a debit, normal balance. Revenue is a credit, normal balance. And here's my equity or capital T accounts. Drawing, a drawing is a debit and an expense is a debit, and a revenue is a credit and an investment made is a credit. So in the big T account called equity, on the left side are my drawing and my expense, and on my right side are my revenue and my investments. Net income is where revenue is greater than expense, and in other words, my credits are bigger than my debits, and my net income increases my owner's equity. So I'm trying to show you lots of different ways to say the same thing, because for each individual that learns accounting, it sticks a different way. So if you like words, here's the words. If you like the T accounts, here's the T accounts. So I suggest you just make some note cards and put all this in the way that makes sense to you and kind of flip through them. It's the best way to learn this, and this is the crux of everything for the rest of this class. So it's really important that you understand the mathematical part of this with these T accounts. Okay. Net loss is where your revenue is less than your expense, your credits are less than your debits, and a net loss decreases your owner's equity. Here's a journal. Once again, we're going to go through a couple of them. Here's fees earned, and the people, your customers don't pay you right away. So fees are earned for services rendered, but it went on account receivable. So you debit accounts receivable and you credit your fees earned. This is what it would look like in a T account. Debit accounts receivable, credit fees earned. Here's the journal. Here's the T account. And I really think when you're learning early on, when you do all the little problems that I've assigned, make your T account. Just get a piece of scratch paper and draw your T accounts, because it's the best way to learn. Okay, here's a journal for some expenses. So this would be like you paid some wages, some utilities, and some rent. And notice, like I mentioned earlier, for every debit or credit, there's at least one opposing transaction. So in this situation, there's 3 debits, 1 credit. The debits add up to the $6,800 and I'm in balance. So my description is I paid for expenses. And here's the journal. Here's the T accounts. Wage expense debit $2,500, rent $3,500, utilities $800, and my cash is $6,800. There it is in a journal entry. There it is in T accounts. And here's one that affects equity. S. Morgan put $1,000, or took $1,000 out of the business. So owners withdraw money when they need it, when there's money to withdraw. So it's not an expense. A drawing is a reduction of equity. And here's what it looks like in a T account. Debit, Morgan drawing $1,000, credit, cash $1,000. Here's the journal entry. Here's the T accounts. Okay, so just another, I want to repeat it again, that each type of account has a normal balance. So balance sheet accounts and assets or debits, and a credit would decrease it. Liability is a credit account. Capital is a credit account. Drawing is a debit account. And then on the income statement side, revenue is a credit and expense is a debit, even though it doesn't seem to show up there. This, if you need to look at it this way, I'd make a note card like this. If you like looking at the T accounts, it's just another way to look at it. Okay, objective 2 is describe and illustrate the posting of the journal entries to the accounts. Okay, so we saw how to do the journal entries. Now we're going to look at how to post them. Posting is the process of transferring the debits and credits from the journal entries to the accounts. So, in this previous example, here was our initial investment of $8,000 of cash and $8,000 of capital, and the $8,000 of cash gets posted to the cash account. The post reference number 1 is the same as the page number 1 up here. The date is 9/1, the date is 9/1, and you would carry this total over to the balance column as you moved through. But for the purpose of this example, I'm just showing you how you get from the journal to the ledger by posting from one place to the other. Now, in today's society, people use computers, and this is all done behind the scenes, but I think it's really important for an accountant to understand what's happening. So the journal is where the transaction is done. The ledger is where the transactions are accumulated. The third objective is to prepare an unadjusted trial balance and explain how it can be used to discover errors. A trial balance is prepared at the end of or at any given point in time to show that debits equal credits, and you prepare it as of a point in time. So usually month end, quarter end, year end. And remember that San Diego designer puppy couture store that we talked about in the previous lecture. Here is a typical trial balance. Notice the title, the name of the company. Adjusted trial balance is this particular one. There's unadjusted trial balances and adjusted trial balances. We're going to talk about the adjusting process in the next lecture. And it's as of a given period of time. So here we have all of our accounts. Notice our assets accounts come down to equipment. And they're all in the debit column by normal. That's their normal balance. We're going to spend some time talking about equipment and accumulated depreciation in future chapters. But accumulated depreciation is a contra asset account, and so it has a credit balance, and we're going to spend some more time with that later. But it is on it is a asset contra asset account. Accounts payables are first liability. Notice our liabilities have credit balances. Our capital has a credit balance. Here's our drawing, which is a reduction of equity. Here's our revenue. And then here's all of our expenses, and notice our debits equal our credits. So this is our trial balance, and you do this after you do all of your journal entries and post them to the ledger. And our fourth objective is to discover and correct errors in recording transactions. Now, even in computer systems, it's easy to make a mistake and make an error. Some of the types of errors we make are transposition errors. This occurs where you write something such as 542 as 452 or 524. Usually your error is divisible by 9 if it's a transposition error. And you would know this when you get to the bottom if you did your trial balance. And let's say you ended up with 325, 525 in the debits, and you had the 585 in the credits. You'd subtract those two numbers, and if you could divide it by 9, then you'd go hunting for a transposition error. The other kind of error people make is called a slide, where they put the decimal in the wrong place. And this happens in computer environments too, where you type 5420 instead of 542. Those are a little harder to find because they are not always divisible by a certain number. Posting errors occur when you're posting from the journal to the ledger. So let's say that the transaction in the journal was 1200, but when you posted it to the journal, you posted it as 1120. So there's all kinds of ways to make errors when you do accounting, and that's why you need to understand how they occur.